Good day everyone. My name is Kisame M. Sawaldi and I'm going to report about the cash flow analysis. And under the cash flow analysis are the operating cash flow ratio, the cash flow margin ratio, the cash debt coverage ratio, and last is the capital expenditure coverage ratio. My learning objectives are the following. First is to learn the concept and uses of the cash flow ratios, and second is to analyze the statement of cash flows of the Universal Robina Corporation. The statement of cash flow is one of the most important financial statement that a business owner use to analyze the cash flow. It made use of ratios that focus on how solvent, how liquid, and how viable the company is. A major benefit of the statement of cash flows is that the user gets a reasonably detailed picture of the company's operating, investing, and financing transactions involving cash. And this can be used to assess the company's current and potential future strengths and weaknesses. Let us now go to the cash flow ratios. First is the operating cash flow. Operating cash flow is one of the most important cash flow ratios. It relates cash flows from that the company accrues from operations to its current liabilities. It measures how liquidity a firm is in the short run. Operating cash flow is computed by dividing the current liabilities from the cash flow from operating activities. As a general rule for this one, an operating cash flow that is less than 1 means that the company is not generating enough cash to pay off its short-term debts. Next, cash flow margin ratio. This ratio measures how efficient a company converts its sales into cash. The computation for this one is cash flow from operating activities over the net sales, and it is a percentage ratio. The higher the ratio, the more profitable the company is. Cash debt coverage ratio. It is similar to the commonly used total debt over total asset ratio. It measures the solvency of a company and its ability to pay debts whenever they are due. The formula for this ratio is cash flow from operating activities over the total liabilities. The higher the coverage ratio means that a business can pay off its financial obligations. Last is the capital expenditure coverage ratio. This measures the company's ability to acquire long-term assets using the free cash flow. And this ratio often fluctuates as business go through the cycle of large and small capital expenditures. The formula for this one is the cash flow from operating activities over the capital expenditures. As a rule, for the capex coverage ratio, if it results to more than 1, this means that the company has it is usually a positive sign for the company. The cash flow ratios vary depending upon the type of company. And in my case, I will analyze the statement of cash flow of the Universal Robina Corporation. For the operating cash flow ratio, we'll just divide the cash flow from operations over the current liabilities. Its current liabilities can be found on the balance sheet. And as you can see, I arrive at an unfavorable result for the 5 consecutive years. This table illustrates that a company has a low operating cash flow ratio, and though it shows an increasing pattern from 2009 to 2010 and from 2011 to 2012, still it is not unfavorable for the company as a whole. It simply means that URC cannot generate enough cash to pay off its short-term obligations. Next is the cash flow margin ratio. This one will just divide the cash flow from operations, which can be found, of course, in the cash flow, from the net sales. And the net sales, we can find the net sales on the income statement. And again, the company, as you can see, the company is not that profitable since I arrived into an unfavorable ratios for the past 5 years. Its cash flow margin ratio shows that this company is not that efficient in translating its peso sales into cash. Being a manufacturing company, URC have a large investment in property, plant, and equipment, and also they are subject to the borrowings of money or raising money through the investors in order to keep the operation going. Next, cash debt coverage ratio. These ratios show unfavorable results for the company. But the formula for the cash debt, as I said earlier, is cash flow from operations over its total liabilities, which can be found on the balance sheet. Yun. Again, I arrived into unfavorable results for the past 5 years. It means that the ability of the company's earnings to cover its financial obligations is low. Therefore, the cash being generated by the cash flow from operations is not that sufficient to meet its financial obligations. Next, capital expenditure coverage ratio. For this one, we'll just divide cash flow from operating activities over the capital expenditure. And as you can see, the results are all favorable. A favorable capex coverage ratio shows that the company generates enough cash to cover its expenses in paying for its purchased capital assets or investment. I therefore conclude that cash flow analysis is a type of financial analysis wherein the timing and amount of cash inflows should be compared with the timing and amount of the cash outflows. A firm's cash flow position can greatly affect its ability to remain in business. The Universal Robina Corporation, in my case, has a low liquidity, cash profitability, and cash solvency. However, its capital expenditure is favorable, which enable them to cover its purchased capital assets or investment, which made their company ongoing until now.